it's visionaries, it's philanthropists, but I think we see that in sort of all the major conferences, and so I don't think that's it. I think that the sheer hustle that exists in the crowd here at eCore and like the desire to get business done is different than really anywhere else I've been. And the energy that flows through in this conference is really exciting and engaging. And being the first conference post-COVID, it's pretty awesome to be here. So thank you to the eCore team, Steve and Veg, and everybody else who makes this conference a great place to be. So today's discussion is really all about the connection between online, so the digital world, and investing in real estate. And for those of you who aren't up to date, I think this is going to be hopefully really an exciting place to learn about what we're doing and why it's really important to you. You have the benefit of having probably the best, I would say, the top 5 players in the market today. And I think collectively, we represent, what, $5 billion a year here? Maybe more? Or $5 billion probably since inception. And so I think that it's really important to understand what we're doing and why. If you don't think that the crowdfunding world is going to change your business, then respectfully, you're living under a rock and it's time to sit up. And I'll tell you why and what's really behind it. And so more broadly, there's a force to be reckoned with that people aren't paying as much attention to. And there's a reason that online investing and crowdfunding more broadly has taken off incredibly well, and the trajectory continues to scale at a pace that you typically don't see in other businesses. So there's a couple of themes here going on that I wanted to touch on. So one is the 60-40 model is dead. The retail investor can't get ahead anymore. The debt yields are in the ground. Private equity and the success over the last 2 decades have kept more companies private, giving people less of an opportunity to create the right portfolio in the public markets. And so where do people go to get ahead? Where does the retail investor, where does the accredited investor go? The second piece is understanding that there's a massive wealth transfer. There's $70 trillion moving from baby boomers to the next generation. And if you go over to the average person in millennial or Gen Z generation and say, hey, do you want to put your money in Charles Schwab? They're going to look at you and tell Chuck to call my dad. This audience is not looking to invest the way their parents did, and they recognize that they can't get ahead. Access to information has given people the opportunity to be smarter about how they invest and smarter about making money. And so the idea that people want to be highly engaged in their portfolio continues to be part of the force that has given us the success that we've had as an industry. And I think the last piece, when you think about some of the limitations that have existed, which I would say are really 2, it's regulation and it's fractionalization. So the ability to actually distribute investments and scale is relatively new because of those 2. What's interesting is that the accredited investor definition is growing because the number of people that are accredited is growing and regulation continues to loosen up. And so your TAM is growing from both sides, giving you a wider and wider pool of people to engage with. So I started Yieldstreet in 2015 with a mission to help millions of people get on the road to financial independence. We decided to do that by providing them access to a broad variety of investment opportunities across asset classes like art finance, marine, litigation finance, private equity, private credit funds, consumer and commercial finance, and of course real estate. We have 330,000 members and growing. We have $2.5 billion funded approximately and over $1 billion returned to investors. And it's just the beginning. And I think that what's most interesting here today that we're going to talk about is the impact specifically that online investing has had in the real estate world. The real estate world has been the fastest growth part of the online investment market. I think there are 2 primary reasons to it. One is a consumer tends to have inherent trust in real estate. Everybody knows or grew up with someone wealthy in real estate, or they see a building and they know it's not going anywhere, or they want to be a landlord. And so selling real estate to people hasn't been that difficult. The second is it's the largest asset class in the world, and that's never going to change. And so you guys are sitting at the intersection of the largest asset class, which is the most supply in the world, and the largest growing demand of dollars. And so the question here, I think, is really how do we, as an industry, cater to owners and operators in the best way possible? I think that in business, people could do several things well. You can only do one thing great. Our focus is on finding the best owners and operators who are going to originate, underwrite, execute, manage, and monetize real estate investments. And what we want to do collectively as an industry is be your capital, is be your support, is change what capital formation looks like, and is give you the operating leverage to scale and to grow your business. Today you're going to hear from these 5 people, which we'll talk about in a second. They're going to tell you their view of where the business is and where it's going, what they specialize in, how to work with them best, who they're looking to do business with. And we're going to try and keep it as free-flowing as possible. If you have a question, just raise your hand in the middle. We'll talk about it. I think the key takeaway for me and what I get excited about is our business is still very new. Our industry is very new. We are only going to be as successful as we can if you guys help us build the right product and the right businesses. So having the right questions, getting the right feedback is what the future of each of our businesses is ultimately going to look like. So with that, let's jump in. We have Ilya over here, Adam, Mitch, Ryan, and Chris. CrowdStreet, RealtyMogul, Cadre, Arbor Crowd, and Yieldstreet. So why don't each of you guys, Ilya, we'll start with you and just go down the line. Do a minute or so on who you are, what do you do at your business, and then we'll jump in.
Yep. Hello. Yep. Happy to. Michael, you stole my entire introduction. Very happy you have that viewpoint. I think from the perspective of if you're a retailer and you're looking at a company that's online selling books, right now you have the opportunity to partner with that online company. Right now we're barely scratching the surface as an industry. CrowdStreet is a firm that facilitates online investment for individual accredited investors. To put in perspective, I want to touch upon Michael's point. The growth that we experienced at our company in the year 2017, we raised about $120 million that entire year of equity. This year in 2021, we'll raise about $1.2 billion. Next year, we're probably going to raise about $2 billion, and the growth will continue. So very excited to be here today, excited to meet a lot of sponsors who I think we could partner with. And CrowdStreet is a firm that also wants to partner with best-in-class operators. We've raised over $2.5 billion across 500 plus offerings to date. We'll do about 112 offerings this year. We have an investor base of 200,000 and growing. And if anyone wants to ask any questions about who the investors are, how we put the offerings up in the marketplace, how we partner with sponsors, we want to make this an open session where we welcome questions.
Adam Kaufman from Arbor Crowd. So we created the company in 2016. We launched our first transaction in 2017. Arbor Crowd is part of the Arbor family of companies, which I'm sure many of you know, Arbor Realty Trust. Our primary focus to date has been on multifamily investments. That's our bread and butter. We think that that's the retail perspective as well. They like to go to a company that really has a strong expertise in one asset class in that segment. So that's what we focus on. Something that we do a little bit differently is that we actually come to the closing table. We write the check prior to syndicating that out, so we balance sheet our deals. We're very selective in the deals that we do. We think given that we have a retail investor base, it's important to do that extra set of diligence. And at the end of the day, if we like the deal, like I said, we write that check. To date, we're going forward and looking more in the single family build to rent space. We think that that's the natural transcendence of where we are right now and where we think the market's going, and we're very excited for that.
Great. Hey everyone, my name is Mitch Rosen. I run the real estate business at Yieldstreet. As Michael had mentioned, Yieldstreet's been since 2015, really with the mission of providing access to alternative investments for retail investors, accredited investors, QPs, and non-AI. Real estate specifically, we've done over $500 million on the platform since 2015, over $400 million in the last 3 years, both debt and equity. And when you think about what we're trying to provide to our investors is access to strong partners, to strong deals, attractive return profiles, and protecting the downside. We're only as good as our worst deal. And so for us, first and foremost, is protecting our investors to ensure that they have a good experience, a transparent experience, a seamless experience, and they want to come back and invest more with us. We will end the year, calendar 2021, over $200 million of LP equity deployed, and we have to do probably $800 million next year.
Hey everybody, I'm Ryan with Cadre. Cadre's mission really has been first and foremost to provide access to end investors, specifically accredited investors, but we also have a slew of institutional and RIA type of investors. But beyond access, the goal is to also provide power to the end investor by offering more transparency, rigorously underwritten deals, transactions, and then also a secondary market kind of post-acquisition. Our goal really is to date, we've operated as a traditional real estate investment manager. We have a fully integrated acquisitions, asset management, finance, legal, and investor relations team that's supplemented by a team of software engineers, data scientists, and product managers that permeate every single aspect of our business that allows us to make better investment decisions, better asset management decisions, and also provide access, lower fees, transparency, and a secondary market to the end investor. To date, we've done about $1 billion of real estate of equity into close to $4 billion of real estate across the country, across asset classes, and across risk profiles. And we offer a slew of different products, again, to empower our investors to make the right decision for them, whether it's a commingled fund, deal-by-deal investing, a separately managed account, and the like. And so right now, post-COVID, we've continued to sort of grow that piece of the business as a traditional sort of real estate investment manager because we feel like track record is the most important brand that you can create. And we're sort of continuing to build that out and hopefully grow from there.
Hi everyone, I'm Chris Fraley. I'm the Chief Investment Officer at RealtyMogul. Excuse me. RealtyMogul is celebrating its 10th year in business next year. We have two different lines of business. We have the limited partnership business, and then we also have two non-traded REITs, which we use to acquire assets directly as a general partner. I've been a long-time adopter of crowdfunding. Prior to RealtyMogul, I actually did a deal with CrowdStreet. I was an investor in the GP that raised capital on CrowdStreet. I actually helped put a deal together with Cadre back in 2017, which just sold. I joined RealtyMogul right about 2017. And I'm also on the board of directors of a blockchain-enabled capital raising company called RealBlocks, which aggregates capital globally. And that's been really exciting to watch explode as well. So thanks.
So to me, sorry, but some of it sounded a bit similar. Let's try to break it up a little bit. Tell me or tell us about, do you focus on equity only? Do you focus on debt and equity? What asset classes within real estate are you guys looking at? Adam touched on SFR and BFR, others touched on GP, but maybe define for us a bit more where you spend your time. Chris, you want to start?
Sure, I'll go ahead and start. So our LP business only does equity. Then we can do debt through our REITs, but it's really not a big part of our business plan. We used to do mezz and pref, but we've found the opportunities to be better on the equity side. On the LP side, we'll do LP investments anywhere from $3 million to $20 million. We do not do hospitality. We do development, but we don't do land investments. And our REITs are focused on value-add multifamily, and the other REIT is more focused on income.
We are predominantly equity. I think that's a function, of trying to do one thing great, as you mentioned, and I think another is just where we find relative value. So as an allocator, as an investment manager, we're constantly looking for the right places to play, whether it's different property types, different markets, different instruments, whether it's equity, pref, mezz, senior debt, that sort of thing. I think generally speaking, the market over the past 8-10 years has been sort of an equity-friendly market, is where you kind of find the most relative value. It's really been challenging for us to find preferred equity or mezz at sort of a really attractive kind of risk-adjusted return, particularly when we feel like there's opportunities that provide substantial upside and just being capped out at 8% or something like that for a lot of the work that our operators are doing isn't really super attractive on a relative value basis.
And Ryan, what's your deal size and property type?
Yeah, so our deal size is about $15 to $40 million.
Check size or deal size?
Check size, sorry. 15 to 40 million of equity. We have an investment committee process that once we get approval, we have a large balance sheet that guarantees funding. So we provide speed and certainty to our operating partners with guaranteed funding. We have a commingled fund we're raising right now with discretionary capital. We feel like that's a differentiator in the market right now, is being able to kind of move pretty quickly.
I think you mentioned something about an asset management part of your business. Do you want to talk about that a little bit?
Yeah, sure. So we sort of operate right now as more of a traditional investment manager, a private equity firm. I sit on the acquisitions team. I source, underwrite, execute on, and structure all of our real estate transactions. We co-invest in every deal that we do. We share in the promote. We're a really traditional investment manager. We think that that is useful for our end investors because we're aligned with them. We're doing a ton of work for them. And then also, what we do on the structuring side is we take majority positions in our transactions that allows us to do active asset management because we have certain controls, whether it's over refinancing, sales, leasing, budget, that sort of thing. We obviously rely on our sponsors, and we heavily diligence our sponsors and have great relationships with them, and they're doing things on a day-to-day basis. But it's when things go poorly that you want to have the ability to sort of step in and protect your asset, right? I mean, COVID was a perfect example. We own one or two hotel assets. We thought the world was ending. We were able to step in really quickly. We modified one of the loans. We never had to make a capital call. That deal is worth more today than it was, 12, 18 months ago. So our structure and the guardrails we create from an asset management perspective really help kind of our end investors, we think.
There's a question over there, someone had.
It seems like there's a lot of liquidity in the market right now, and it's becoming increasingly harder to raise capital with sponsors. So how are you guys dealing with that?
When you say place capital, do you mean a function of finding the right deal, or there's no lack of deal flow?
It seems like the average conversation I'm having at this conference is, hey, I want to help you raise money, and the average response that I'm getting is, that's not our problem right now. We don't need them.
I could jump in. So for us, what's been very beneficial is the synergies that we have with Arbor Realty Trust. It comes with a lot of relationships, and that's part of our differentiator. So I'll also answer a little bit of what your question was going down the line here. We focus on multifamily. We think that's the bread and butter of the industry. We have a tremendous amount of expertise in that area. When you come to us, we present ourselves as a one-stop shop. You have the REIT on one side that is capable of doing the debt in the transaction. We can come and facilitate and do the equity. What we really like in a deal is seeing where there's a sponsor who has strong fundamentals, but is looking to close that equity gap of 5 to 10 million, doesn't want to go to their family and friends, raise that money. We can be there. They just deal with us. We pride ourselves on being an asset manager. So for example, just this year in the beginning of COVID, 2 things happened for us. One, the business plan of a deal that we invested in changed. Normal course of business, that can happen. We went to the table, we negotiated with that sponsor an exit for our investors, because that's not the deal that our investors entered into. Not to say whether that deal was going to be successful or not, it was different, putting that down to rest. And we were very happy with the favorable outcomes, and so were our investors. They were in the deal for a year, they made a little money, but they didn't get dragged along for what happened during the ride of the rest of the business plan, not to mention COVID. Secondly, because we balance sheet our investments, we thought it was wise to take a moment in the industry, not knowing where things were going to go, and not launch a deal during this time. We focused on internal growth, we built out our technology, we warehoused that transaction, that's something that we have the ability to do while we still own it internally, but really look out for our investors, and that's why people really do like us. In terms of answering your question a little bit more directly, we have a lot of relationships that are built in. You know, I think a lot of the buzz around this conference is that everything's happening off market, right? So because of the relationships we have with the REIT, we're able to have access to quality deals. Not to say though, we operate side by side with them, my underwriting team, their underwriting team, one-stop shop with good quality sponsorship.
I'll take it next. That's a great question. CrowdStreet, we're looking at somewhere between 500 to 700 deals a year, and we need to transact on about 112. It comes up all the time. It's like, who's your biggest competition today in the market for the LP equity? For us today, it's a big family office who could write a very fast check. There's a lot of liquidity out there. That's very true. Right now, any deal we look at, there's 5 other term sheets, and sponsors are choosing us, online syndication, online investment. Many times it's control rights. That's the biggest selling feature. Our LPs are passive. In control rights, also mostly in behavior. Also, you're future-proofing your business. You're meeting a whole new base of investors. Once you're on the CrowdStreet platform, it's tough to get on. But once you're on, you now have access to hundreds of thousands of new investors who are going to tell their own friends. Basically, think of any shul, any country club. If you do right by an investor, they're going to tell their friends. With CrowdStreet, you're in every shul, every country club, every church, every organization. If you do right by them, your next deal is going to oversubscribe. You're not doing it just for today. You're doing it for the moment when there isn't liquidity in the market, right? When March 2020 hit, every institution went pencils down. CrowdStreet didn't. Individual retail millionaires still wanted to put our money and invest into commercial real estate. And that was an opportunity for us to win the market. There were sponsors who were thinking, should I try this, should I not? When their traditional partners said no, retail individual investors didn't. And then you'll see in 2021, late 2020, some of the biggest names in the business started using online syndication, the online fundraising route. And once they tried it, they said, wow, there's something here, there's something to it. And you know, some big names are now on their second or third, fourth deal within just 1 year.
So speaking of liquidity and moving into a different direction, retail investors for too long have valued liquidity and they've overpaid for it. Being that what you guys are all catering to is illiquid real estate investments, as the retail investor continues to be more prevalent in the capital structure, what are you guys planning, thinking, doing with regards to creating liquidity in these illiquid investments?
I'll jump in here. Excited to get the turnaround. So it's clearly, you know, real estate as a illiquid asset, as Michael had mentioned, has really been one of the asset classes that is the reason why REITs exist, public REITs, right? It's a way for a retail investor to get access to real estate exposure with world-class managers. The difference is that there's volatility in those asset prices based on the stock market. And so investors said, I don't want the volatility of that, of those assets, and how can I find it on a private market but still get liquidity? The reality is that when you have investors that want to come in and want to go out, the best way to try to match that is not very easy. And so you do it in a diversified fund model, you do it on a one-off basis. At Yieldstreet, in all of our deals that we're doing on the equity side, we have control rights for purchase of a forced sale. So in the event that our GP partner says, you know what, I want to hold this asset for 10 years, they can't do that. We have the ability to kind of force an execution, force a liquidity event, and get our investors their money back. That's certainly one of the biggest things that we try to promote to our investor base, is that forced liquidity event at some time frame that we market the asset for. It's a 5-year deal, then in 5 years we can force a sale and get their money back. We do intend to launch a secondary market at some point in the next 12 months. We're very excited about that. I think there's more to come. But it's two things that we try to differentiate ourselves in terms of control and forcing liquidity event that investors may want to have.
Ryan, you guys have something already in the works on the secondary market, right? Do you want to talk about that?
Yeah, so I think just when you think about real estate as an illiquid asset class, why is it illiquid? It's illiquid because people, you know, you have the private equity funds, closed-end funds, the gatekeepers are sort of keeping those things closed. What happened in the stock market in the 80s, E-Trade came about, decided to say, hey, we're going to reduce the barriers to retail investing, lower fees, more transparency. You go on your E-Trade account or your Robinhood account today, what do you have? You have reams and reams of data. You have a super liquid stock market and bond market. You have 10Ks, 10Qs from the SEC forcing them to be super transparent about what they're doing. You've basically had none of that in real estate until very recently. So the infrastructure of data and information and just the way to actually exchange money and shares has just not existed. So what we did at Cadre is we created what's called an alternative trading system where we match buyers and sellers. We create our own investment entity that our investors come into. We have the ability to transfer investors in and out on our platform using technology. And so for us, this is just a key piece of our business. It's not just enough to provide access to investors. And you need to provide power and transparency to investors. They need, post-acquisition, they need to be able to do more with their money, whether they have a personal life decision, whether they just feel like multifamily is not it anymore and they want out of multifamily, they want this or that, right? They need to be able to have power over their decision making. You can get liquidity in real estate today through the publicly traded REITs and the non-traded REITs, which is the big behemoth staring us in the face right now, but that happens on a very diversified portfolio, right? Hundreds of assets across the country and across property types. How do you trade shares in a single asset or a single market at a really granular level? That's what we're trying to create. And again, we've executed on hundreds of trades to date, and hopefully that'll continue to grow.
I could jump on liquidity there also. I think at the end of the day, the retail investor, there's different deals with different business plans. And we present ourselves as a way for the retail investor to connect personally and diversify. So there's different appetites for different deals with different business plans. And it's up to the investor to really decide what works for them. And that's how we market. I think the secondary market concept is great. I think we're just at the beginning of it. There's some success that's starting, and there's going to be a lot there at the end. But that almost becomes a different business. Right now, we're still working on the fundamentals of where we're at. And it's about diversification and educating the investor base to the best of your ability for them to understand the different options that they have and choosing if they want a more liquid option or less based on the different deals.
Do you think that's true?
In terms
Meaning,
of their ability.
do you think the retail investor really understands how to price liquidity? Or do you think that as the market continues to develop, that the retail investor is going to demand liquidity? And if others are building it, and I think about this all the time from my seat, if Cadre's building it, if we're building it, if others are building it, could a player sustain a long-term scalable business without liquidity?
It's a good question. It's been sustained, though, for decades. And I think that we have different base at the end of the day. I think, we go after the accreds, so I think there's an inherent difference in terms of ability and knowledge there. Obviously, a broad definition. I think the non-accred's a little more difficult, and I'm not sure if you're referring to that directly or not, but I think liquidity is the future and creating a secondary market. But I do think people have the power to make decisions and understand at the end of the day, do they want to invest in a deal that has some more cash flow, longer term hold? Do they not? Do they want to take more risk? And I think that's up to them.
Yeah, and then if I could jump in on the topic, I have a somewhat controversial viewpoint that was formed in the last few years. I think liquidity for individual retail investors in commercial real estate is not so important. We just had an offering, it was a $30 million raise for a tokenized deal, first of its kind. It actually turned investors off. So our investor today is a 55-year-old with a net worth of 10 to 15 million, and it's kind of going up. What we found is that they want to be in the deal for the long term. When they look at a real estate investment, they want to be in that deal for like 3, 5, 7 years. And we actually just had an early exit on a deal. It was like in a year, investors received like a 30+% IRR, way above pro forma. And then they're like, what are we going to do with all this money we just got back? We put it there for the business plan, but the marketplace was on fire. And actually, I think the secondary market is still very far off. And it will be important, right? I used to think it was like the holy grail of finding online investments, and that's what's going to be incredibly important for investors. Not so much today. I think everyone wants to invest in a traditional way. The average investor doesn't have access to commercial real estate. I think they're excited just being able to see a deal from a top sponsor, seeing a deal in a market they've never been to, like in North Carolina and Austin, if they live in California, if they live in New York. That itself is very exciting. I think the products that we offer here as a company, or our respective companies, we don't need to tap into a secondary market just yet. That could be a decade out.
Yeah, I think we debate that all the time, more broadly, as an industry. I don't agree. Not everybody in my team agrees with me, though. I think that it's an adoption curve that we're looking at. And so we have currently hit the early side of the adoption curve. I don't think collectively here we represent even 10% of the accredited investor market in the US. And so we really haven't scratched the surface at all. In the accredited investor market in the US alone, there's $15 trillion. And so the investor that we've successfully attracted as an industry is the one that's comfortable with the illiquid profile of what we sell. But if you think about really penetrating the market and getting 10, 15, 20, 25% of the accredited investor world to move cash online to platforms like you guys and just us broadly, I think that the notion that I can access liquidity if I wanted it is going to be a big pull. We launched the third test of our secondary market, and we had 3 people ask for liquidity in a deal with hundreds. So our experience has been the same, but I think it's directly correlated to the type of investor that we've been attracting as an industry so far.
Was that a real estate deal?
No.
So I think at the end of the day, we have to remember we're talking about real estate here still. And I think real estate traditionally has been an illiquid investment. Now, secondary market developing, yes, agreed. There's a future in that. But people right now have other options for more liquidity in terms of if they want other pursuits. At the end of the day, real estate is not, it's not a liquid investment, and people understand that when they come in and they take the other safety risks, let's just call it, or non-risks, understanding that they're investing in a tangible asset in real estate, and they're happy to do so.
Ryan, how's your adoption trending on your secondary market?
I think I agree with you. It's still early in the stage. I mean, of the whatever hundreds of investors on any given deal in a specific quarter, you might only get 10 or something, you know, I'm making up numbers, but on a specific deal. So yeah, most people go in, and look, we have institutions and large wealth managers on our platform who are definitely just holding things until fruition. So we're talking about the high net worth investors. So, but we've definitely seen from when we launched this in like 2017 or 2018 to now that just the number of trades per quarter has gone up substantially. And I think we're forgetting about just like the big behemoth out there of the non-traded REITs, right? They're going to be on track for $30 billion of real estate, of capital commitments this year. One of the big pulls there is you get liquidity, right? Every RIA, high net worth, everybody wants more power over their investment. We get, one of the big pulls for when we go after these RIAs is we can provide this secondary market to them. And so this is just an option. Look, it's not everything, right? You got to be able to do good deals. You got to have a track record. You got to be able to provide a good service and all that sort of stuff. But secondary market over time, I think our view is, I agree with Ilya that it's not happening tomorrow, but there's no reason there shouldn't be a digital stock market for real estate, right? Like, it's really easy to underwrite a multifamily deal versus underwriting whatever the heck Facebook is trying to do with the metaverse, right? Like, I have no idea how they're doing it, but you can go online and see tons of information, and with a click of a button, you can, put all your money into it. Same with Bitcoin. Like, Bitcoin, I still don't really get it, but every retail investor likes it in part because it's liquid. So if you can figure this out, and look, there's regulatory, tax, legal, data hurdles, there's every hurdle you can imagine to figuring this out, but I think if you can figure it out over the long term, that's going to be really impactful for investors, but also for us on the acquisition side to attract sponsors. Because if you can tell a sponsor, I can get you a promote and you can still own the deal and have permanent capital forever, why would every sponsor would want to come to us to provide that? Because otherwise that sponsor needs to churn out their deal every 4 or 5 years and then go find another one, right? If they can hold a deal for 10, 20 years and still get a promote, that's the ideal scenario for a sponsor.
If I could step in for a second. So when you think about where real estate investors and owners get tripped up, it's the asset liability mix. I would argue that the liquidity he's highlighting with regard to the mortgage REITs and the large non-traded REITs is really a facade. You have a fixed rate asset in these funds, and the liability these funds have is the redemption requests, right? So in reality, what happens, and I've been in the seat at other hedge funds where this occurred to us, the optics of the liquidity is not real. If you have 20% of your LPs request a redemption, the gates are going up because there's no way to monetize those assets. So if you think about 2020, some of the largest funds out there in real estate, and the big names we all know, all put the gates up because they had massive redemptions they couldn't meet. So I would argue that I would disagree with Ryan here. Like, this facade of liquidity is great for marketing. In reality, if people go to the gates, there's no cash to pay them because the asset is not easily monetized. So the way you have to do this is very delicate and really transparent, because I think you actually will burn more investors by creating the facade of liquidity when in fact it does not exist. The second thing I would talk about in regard to the digital stock market and real estate is that he mentioned regulatory, he mentioned like SEC filings, 10Qs, 10Ks. In real estate, the transparency of those that information is very hard to gain trust in, right? It's provided by the owner. It looks like an Excel spreadsheet. There's no audit or there's no Deloitte stamp of approval that this has been vetted and checked out. And so I think if you actually try to distribute that, if you're an owner, people in this room, do you want your financial statements distributed broadly to retail investors, right? Do you want them to know what you're making, what you're not making, what you're paying in taxes? I would argue that many actually prefer the privacy of that anonymity. So how do you think about that when you enter the crowd space, right? There's different ways to approach it. Do you want your name highlighted or do you want it hidden? We can do both, right? If you don't want your name out there, we can talk about your track record. So these are things that we try to be a little nuanced with, particularly on the debt side of the business. We've launched over $400 million of debt product, mortgages, pref, and mezz, with never once mentioning the underlying borrower's name, their address, or their net worth. I think that's really a powerful statement. Think about that, right? These are investors who are highlighting the property and the market that it's in and gaining confidence of that investor through that information. So those are two things I'd highlight.
So I'll take the bait and switch gears now, because what I heard you guys say during your intros is essentially, I think your goal for 2022 collectively is around $3 billion of net new origination. Just listening to the numbers that sort of floated, maybe I missed it, maybe it's closer to 4 in the aggregate. And so you guys have $4 billion to spend, most of it on equity commitments, on LP commitments. So who is your ideal customer, owners and operators sitting in this room? Who do you want to do business with, and what is your strategy? Right? Where do we get differentiated here? Chris?
Yeah, I mean, we're looking for probably 2/3 of what we do is value-add multifamily. We can do every, we're able to do every asset class. Like I said, we do not do hotels. On the development side, we're looking for sponsors with a minimum of about $400 million of development experience. On the existing side, we're looking for a track record of about $200 million. And we also do have an emerging program for sponsors that do not meet those thresholds. We do have an in-house asset management team that, if for some reason things go awry, we do have the ability to help or take over during a difficult run.
What's your average deal size?
Probably right now, I mean, the range is 3 to 17, and our average right now is about 5.
Market? Which markets?
We're pretty, I don't want to say we're agnostic to the market, but pretty much the Smile States is, if you looked at a map of the 200 deals we've done, 95% of them fit in that range.
Adam?
So our focus is definitely multi, and our check size right now is about 5 to 10 million. And we're looking to partner with people who are committed to their deals. You have people, like I said, who want to come and close that equity gap, and they don't want to do it elsewhere and deal with the headache. One of the benefits of us is we actually go for less control rights, and from what I'm listening on this panel, I think people go for more. But we look at the deal pretty aggressively.
Which markets?
So we have a pretty macro approach to the markets. Obviously, with the experience of the REIT side by side, where we have access to a lot of not only data, but a lot of information and experience. So pretty macro in general, I would say. but solid fundamentals with a sponsor who is committed to the business plan, both financially and its backbone. And we come in, we can write that check up front, like I said, and we can also offer a full capital stack solution with the REIT.
And how much are you looking to do next year?
So right now we're very aggressively looking in the build-to-rent single-family market. We have a platform-level relationship that we've generated, and we are doing about $10 million per deal. So I would say we're doing about $100 million next year.
100 million next year. Okay. Ryan?
Yeah, so I think we tend to focus a little bit similar to Chris here on just really seasoned, experienced operators with a specialization in their markets or asset classes that have invested across real estate cycles. And so, you know, they're co-investing in their own deal to align interests. They're getting promotes to align interests with us and our investors. All of those sorts of things. They have an institutional sort of track record. In terms of markets, we're in about 20 markets. I'd say we have this Cadre 15 that our data science team has sort of created for us to select 15 different markets where we kind of follow the 80-20 rule. We try to spend 80% of our time in those markets. And then we're doing multifamily acquisition, multifamily development, industrial development, hotel and office as well. But I'd say probably the benefit of most of us on here, or the value that we try to add to investors, is our ability to, as an allocator, to be able to pivot into different asset classes and different risk profiles depending on where the market's headed. You know, I think pre-COVID, we had a slightly different approach than we have post-COVID, and by nature of us all seeing kind of hundreds of different deals, we can sort of pivot into where we find relative value.
So just to break it down, deal size, you said 15 to 40 before?
Yeah.
Asset classes?
The major food groups, mostly multi-office, hotel, and industrial.
Geography?
Mostly southeast and southwest.
And what type of owner-operators?
Institutional, seasoned, hundreds of millions of dollars of deals in their track record.
Okay. Ilya?
Yeah, so we want to look for great partners that we could work with and develop a programmatic relationship with. It's a process to get the first deal across the finish line with CrowdStreet. It's worth it if you do multiple. First time, it's a learning curve. Second and third, it becomes second nature. It's also a lot of fun. Today, CrowdStreet has about 175 employees, and we're hiring about 10 people every month. 30 to 40 of those employees are on the investments team. So we're in every market. We have people in every metro area you could think of. We know every market. We want to be in, well, we have an investment thesis that we like to follow, but outside of that, we could also do deals in, you know, you name it, Newport, Boston, some Boise, Bozeman.
I think what's interesting is I've spoken to a lot of people over the last day or so, and there are a couple of different groups. I would sort of break them out into two groups. There's the emerging owner-operator, who has been successful, moving quickly, scaling, aggregating, you know, pretty substantial number of units or properties, looking for the right platform to partner with. And there is the more mature owner-operator, could be second generation, could be a fund, who's looking for a different type of a relationship. And my view is that the different, you know, organizations here cater to different clients. So I think that, you know, hearing, and I wonder where you guys are a little bit better, but I would say Arbor and RealtyMogul sounds like you're looking at the smaller deals, good track record, good sponsor, but you're willing to do $5 to $10 million check sizes and sort of scale with people in different markets. I would say Cadre is definitely on the higher end of the market, looking for larger operators, larger check sizes. We'll hear from Mitch in a minute. But where would you put yourself? Are you looking for local owner operators that are building businesses that need a good partner?
A big part of our business is actually working with enterprise groups, and that's growing. So that's groups that have, you know, 5 billion and up of experience. We unfortunately do not have a program for emerging managers at the moment or anymore, but we do work with a number of seasoned, tenured groups. Our sweet spot is probably that tenured group that has about $500 to $1 billion of activity. Lots of second generation, third generation firms whose original investors are aging out, and you're seeing that next generation take over. They want to future-proof their investor base, so that's why they're working with CrowdStreet. As opposed to Yieldstreet, our process is very public. So the sponsor themselves makes the presentation. It's not CrowdStreet that's providing the offering, it's the sponsor. And we're building a direct relationship between the investor and the sponsor, kind of like Match.com, but for real estate. But, you know, so they feel like they get to know you, except you don't have to see them at weddings and bar mitzvahs. So, you know.
Mitch, what's,
Yeah. So our target GP partner is someone, I think, not unlike Chris, maybe $200 million and up. A track record we could look to, some realizations clearly. We're not looking to do the first construction deal with them, ground up. We're not going to do their first hotel deal. So clearly we want to see someone who's experienced in the asset class or property type, and ideally in the same market that we're looking to get involved with. Our check size on the equity LP business is between $5 and $35 million, maybe even $40 million. We have done deals as small as 6. We've done deals as high as 28. So it varies. Again, similar to, I think, what Ilya had highlighted, we're not looking to do one deal with one partner. There's a lot of upfront work in terms of underwriting that person and that organization, looking at how they operate. Negotiating a JV could take weeks. It's very specific and time-consuming, and so if we're going to pull that time and effort in, the hope is that the desire, the goal is to be doing multiple deals with that partner. And if you look at our track record with our existing LP partners, only 12 months in, we've done 2 deals with 2 different partners already in the first, 6 months. So that's what I would say on that side. In terms of the markets, I wouldn't say I'm agnostic either, but we have found attractive deals in the Midwest. We just closed an industrial deal in Columbus, Ohio, which has a less than 6% vacancy rate for industrial product. It's a logistics site. So things like that off the run that I would say, there's a reason to dig in and learn more about those markets. We did an industrial deal in Norfolk, Virginia, with a lot of government tenants, subcontractors in the security space, contractors that do work for the military. These are long-term contracts on very expensive projects. 83% of that tenant roster is IG, right? So you're getting an 8 yield day one. That's a pretty attractive deal, although it's not multifamily, right? You got to find yield some way and some off-the-run product. We're not just multifamily, although that is our core focus, but we will do a deal anywhere where it makes sense. It's all about risk-reward and the partner you're in.
I think it's a good time to see if some of the owners and operators have questions about what you guys just spoke about.
Three questions real quick, rapid fire down the line. Timing for the see a deal. So I'm sure you only want to see it when you've won the deal. You don't want to see one of the best and final time for the guys. Once you've won it, you want to see it, right? So once you've seen it, timeline, get back to us after you've underwritten it. Ask all the questions that you have to ask. That's the first question. So the timeline on that.
Let's do one. Let's go on the way that you ask. First.
Yeah, I'll go first. So is the question timing on the process or timing on the raise?
Both.
Okay, so timing on the raise. CrowdStreet is a best efforts platform. We don't buy the market. We don't have a balance sheet that we invest, so it's not guaranteed. However, you're thinking, like, why would you go this route? If we're putting out a proposal, we feel very confident that you will either meet or exceed that estimated raise. So on the timing, we did our first deal this year with Extel Development, Gary Burnett. Excellent marketer, knows how to do his deal. $26 million allocation. If you had to guess, how quick did he raise it? Or how slow?
Well, I think he's asking you how quickly did you give Gary the estimate? Did you underwrite it? And
Both sides.
Yeah. Yeah. So first part, he raised it in about 30 minutes, right? And oversubscribed off the marketplace the next day. It's like $40 million in offers. How long does it take? It takes about, call it 3 business weeks to screen the opportunity, to get it through screening. It could be quicker if everything is already kind of done up front. And it takes about 2 to 3 weeks to look over the legal work. You have a dedicated slot on the calendar, on the launch calendar. It's a curated marketplace. So all in, before it even goes up in the marketplace, you have about 4 weeks of work ahead of you. So 60 days is the process from start to finish, typically. So make sure you have a time buffer if it's a live acquisition, if you're going to CrowdStreet, at least 60 days. But we let you know if CrowdStreet's in the deal about 2 weeks in the process, so you could dual track it. You could talk with everyone. And then, when we give you the proposal, it's up to you if you want to accept it or not.
We've done it in as quickly as 2 weeks. And for us, because we write the check up front, the raise really is de-risked. But we've also raised in as quickly as 2 to 3 days, maybe sometimes 30 days. If you're dealing with Arbor on the debt side, their process is a little bit different, but we are working side by side.
For our standpoint, we have a $400 million balance sheet that we could access for capital. So every deal we do, we balance sheet first. It's not a best efforts raise. We take the principal risk. If we can distribute it, we own it. In terms of timing, we get back to you in 5 business days typically, and we've closed equity checks as quickly as 3 weeks.
We also have a balance sheet that we fund every single deal on before we send it out to investors, and then we have a discretionary fund behind that. So as soon as we tell you yes, it's guaranteed funding, we can move in as little as a week to get sort of formal investment committee approval, but we'll work on the time frame, and we'll occasionally go in on bid processes. We don't love dealing in marketing things, but we'll go in before you tie it up on occasion for sure.
I don't want this to be the standard, but we have gone from submission to funding in 2 weeks. And in that case, the deal was submitted, we funded on our balance sheet, and backfilled the capital afterwards. But really the biggest time hurdle is the sponsor submitting materials, as you can imagine. I mean, we have full diligence, just like any private equity fund. I came from Rockwood Capital, very institutional process. It's no different at RealtyMogul, and probably all the other funds, all the other groups as well.
Upfront fee structure and ongoing fee structure. So if you bring me 100 investors, cost for that, if they're mine, they pay me afterwards, or I'm paying you for perpetuity for 18 months, 24 months. What's the point there?
Call me. Well, our fees, we invoice the sponsor. Typically, those costs are structured into the deal, disclosed up front to the investor. For more details, please reach out to CrowdStreet or anyone on the team. Thank you.
Ooh.
It depends, but mostly we charge our fees to our investors. So it's actually, and we actually, the sponsor gets the promote against the crowd as well. So pretty favorable there.
We don't promote our LPs in the Yieldstreet entity. We pay a promote to our GP, obviously. There is no ongoing fee to this GP. But our investors are our investors and ours alone. We also deal with them, file K-1s, answer questions. So unlike some other folks here, you are not facing, the LPs are not facing the GP directly. There's no privity, right? So those are our investors. We source them. We service them. It's one K-1 to our LP. You're not filing 200 K-1s across the investor base. In terms of, sorry, what was the other question? The second part of it? Oh, the fees. So we do capitalize a fee up front to the JV. It's a one-time fee, and it varies by deal.
We don't ask the sponsor to pay a fee. We pay the sponsor, and we charge our investors on the other side. Similarly, you're only going to ever have to deal with me, for better or for worse. You won't have to talk to our investors, answer any questions. We do the diligence right alongside you as you're doing it. So it's a really traditional sort of investment manager approach, like you're probably used to.
We charge a upfront technology fee, gets passed on to the project. That's a per investor fee for running them through the process, and then we also charge an ongoing asset management fee.
So our business has grown at a crazy pace over the last number of years. I'm a believer that it's just the beginning. We spoke a little bit about retail adoption earlier and the technology acceleration. Not to get too touchy here, but I wonder if we're here in 5 years at eCore 2026, are all 5 of you still on the stage? What happened to your businesses? Are you going public? Are you partnering? Are you JVing? Are you merging? I think there's a fight for eyeballs, right, to go after the consumer. And what do you think is the future of real estate crowdfunding?
Yeah, I think the funny answer anyone could say, oh, it's just me up here in 5 years, right? Anyone was, but
I'll ask you why.
yeah, but if you look at this space, if anyone confuses it with kind of crowdfunding, a novelty, I think it's an error, and you're kind of missing what's being grown. It's basically an online investment platform geared for an investment base. How large did you say the accredited investor base was in the United States?
16 million people.
16 million people and trillions of dollars historically untapped. So can KKR, Blackstone, these are big names, but can they coexist? Can Newmark, Meridian, can they coexist? There's a lot of business here, and there's different niches potentially that every company could hit. I think we are barely scratching the surface. I think the runway is so long from here. $2 billion a year next year, and we think we are just at 10% of what we know potentially we could raise. And from here, I think maybe you're wearing a fur coat with diamonds or something like that, but I think we're still going to be here in 5 years. And eCore is an event that, you know, even the best operators in the business, you know, still show up to. So hopefully it's something that many of you have already tried in 5 years, and it's not a novelty anymore in 5.
I think it's important to really understand the magnitude of the capital that is being raised on this stage. You know, coming from Rockwood Capital, we were $1 billion fund. The way a $1 billion fund works is you spend the first year, and this is on all closed-end private equity funds pretty much. You spend your first year raising the money, and 3 years placing the money, and then creating value, and then liquidating. So in a $1 billion fund, you're basically investing $250 million a year. Pretty much everyone on the stage is doing that already. So I think that what our industry is not really internalizing is how intensely we are disrupting the closed-end private equity fund model, which is really the main financing tool for operators for the last 20 years. And but I did a whole podcast on this with Adam Gower at Gower Crowd, which if you're interested in really understanding the crowdfunding world, he's a really great person to follow. Get on his email list. If you have a spare hour and you want to hear more about it, it should be coming out any day now.
I'll jump on who's still here, because I think we all agree with just scratching the surface, and there's a lot of untapped areas to explore, and it's just growing, and access is just growing. I think the regulatory environment will follow soon. I think we're near that. I think that the people who are here are the people who have had successful deals on their platform, people who have been successful in doing that, while simultaneously also understanding the cost of the business. We all know it's an expensive business to run and be in. There's a lot of costs, understanding the fee structure and how to survive. And I think that that's something that cannot go under discussed.
I'll jump in here. I think when you think about the landscape of crowdfunding in particular, real estate had a really attractive carve out from the regulations and the laws that were passed, and that's why you're seeing so much more in the way of competition and platforms like the ones you see here who are trying to raise money for real estate assets. And that's going to be probably likely a continuing theme, even looking at the next 10 years, 20 years or so. Real estate has this very interactive spot within the tax code, both on the REIT structures, depreciation, and that's not going away. The question is, are you going to have 30 different platforms targeting real estate and crowd platforms? I think the answer is personally no. When you think about, does someone want to have 10 different apps for 10 different investment platforms that they invest on? I also think the answer is no. They may want just one that has access to all different asset types. It'd be real estate and other asset classes. That's the theme and the hypothesis that we're kind of growing off of, and I think that trend will continue.
Yeah, it's also important to point out that there's dozens of companies that aren't up here right now that no longer exist that try to be in this space, right? So I think people in the audience are also looking at, up until this point, the winners of the space who have been doing it correctly, who are continuing to dominate, and then after the space consolidates a little bit, just the market
That's the
shares
background
there.
of the question, right? Is consolidation over or still happening? Is there still a survival of the fittest game going on? And that's not exclusive to us, but it's interesting to see it here.
I think what we're forgetting here is the big asset managers have really just started trying to tap this type of capital. Blackstone and Starwood have raised $20 to $25 billion of RIA and wirehouse capital this year. That underlying investor is a high net worth investor, an accredited investor, or a qualified purchaser, right? They are tapping this, and if you read Blackstone's earnings, they think BREIT will be the single biggest profit driver of their entire company. So they are making an all-in bet on this, and you're seeing KKR, you're seeing Ares, Brookfield, and there's probably going to be like another dozen big asset managers over the next year or two launching non-traded REITs or interval funds and trying to get into this space. And they're going to do it with imperfect products. I think, going direct to a single deal, I think is probably the most powerful way to invest for an end investor, but they're going to attach their brands to this and really power through. So I think that's going to be a thing that's coming down the pike.
Blackstone raised $8 billion last quarter in the B-REIT. So it's like, yeah, you think about the numbers here. That's 1/4 of their marketing effort. It's substantial. Any other questions from anyone?
One over here. And then I think we got to run.
Yeah. So my view, this is me personally speaking now, I think when the Opportunity Zone program came out, there was a lot of enthusiasm and a lot of hope around what it was going to shake out to be. I think if you ask 100 people, 80% of them would say that it's been probably underwhelming in terms of the demand and appetite around it.
Didn't Cadre start an OZ fund or something?
We went pretty hard at it in 2019. We have not done anything since COVID. Not that we won't, but it's not a big piece of our business like it was at the beginning.
Yeah, so maybe that speaks to it a bit. I think when you think about the duration and the motivation for some of those investments, if you're making an investment under the cloud of tax avoidance or tax mitigation, I think inherently you could make mistakes. And I think putting a 10-year investment out there for our investors right now is not ideal. Also, to reap that benefit, you have to actually roll over capital gains. So the timing aspect is also quite complex. And so with retail in particular, it's hard to herd all those investors. I think with institutional partner, it's probably a lot easier to do that with a much longer family offices type.
I think that's where liquidity in the future is going to play an interesting role, because as you can mark the asset over the years based on the progress, so I can invest day one in the dirt and I can sell it in year 4 at a value, at an accreted value based on sort of the work that's done in the as-is value. So I think those are some areas where the future of liquidity and retail are going to change how you think about capital formation. I think the broad idea is, can you buy real estate and never sell it, but let the owners trade in and out of it?
Yeah, to go back to that question, Mitch, very surprised by that response. What we found, some of our best raises have been Opportunity Zone deals. We actually lack product right now. We launched our own fund, second fund, and I think maybe because CrowdStreet investors skew a little bit older, but they have a significant amount of capital gains from the stock market that they want to parlay somewhere else, but you can't do a 1031 exchange with stock gains. They're looking at CrowdStreet as that source of deal flow. So with us, we have multiple successful offerings that had 10-year holds that were structured as opportunity zones.
Yeah, I would agree. We are constantly getting calls about doing opportunity zone deals. I mean, you're looking at a stock market that's up, 50% from prior peak. There's a lot of gains out there to be spent.
So, Ilya, just to confirm, so 10-year duration for you guys is good?
On opportunity zone offerings, yes. And
That's
then
great.
also core product, yeah, potentially works.
Awesome. All right, I think we got to wrap up. If anyone has any questions, find the panelists when we get done.
Thank you.
Thank you
Thank
so
you,
much.
Michael.
Thank you.